Every generation believes it has found the technology that will change the future. Sometimes it's right. The steam engine transformed industry, electricity reshaped everyday life, the internet connected the world in ways few people could have imagined. Today, many believe artificial intelligence belongs on that same list. Others believe something very different. They argue that AI isn't just a technological revolution. It's the largest financial bubble of our time. But history suggests those two ideas don't necessarily contradict each other. Some of the world's most important innovations also became the center of its biggest investment bubbles. So perhaps the real question isn't whether AI will change the world. It probably will. The better question is this: are investors repeating a pattern that's been unfolding for centuries? To answer that, we need to stop looking at the technology itself and start following the money. Most discussions about artificial intelligence focus on one thing: demand. How many people are using it? How quickly it's growing? How much revenue it could generate? Those numbers dominate headlines because they're easy to measure, but experienced investors often pay attention to something else: supply. Not because demand doesn't matter, it does, but demand can be driven by excitement, speculation, and expectations. Supply is different. Every new factory, data center, semiconductor plant, or AI chip requires real money, real resources, and years of commitment. That's much harder to fake. Throughout history, some of the biggest investment bubbles weren't revealed by soaring demand. They were revealed by an explosion of capital flowing into the same opportunity. And that's exactly where the story of artificial intelligence becomes far more interesting. The scale of that investment is difficult to grasp. This year alone, the largest tech companies will invest roughly $725 billion in AI. It's a number that's easy to hear and almost impossible to imagine. So let's put it into perspective. Imagine spending $1 million every single day. Not for a year, not for a century, but every day since the birth of Jesus Christ. You could spend through the rise and fall of empires, the Industrial Revolution, and both world wars, and you still wouldn't reach the amount big tech is expected to invest in AI this year alone. That's roughly $2 billion every day. More than $83 million every hour, around $23,000 every second. By the time you've watched the first few minutes of this documentary, millions of dollars will already have been committed. The question is no longer whether companies believe in artificial intelligence. Clearly, they do. The real question is whether history has seen this level of investment before. History suggests the answer is yes. Again and again, revolutionary technologies have attracted extraordinary amounts of investment. A long-term study examining 175 years of innovation reached a remarkable conclusion. Out of 51 major technological breakthroughs, 37 were followed by large speculative financial bubbles. The technology wasn't the problem. In many cases, it went on to change the world. The problem was that investment often grew faster than reality could justify. Billionaire investor George Soros once explained it this way: stock market bubbles don't grow out of thin air. They have a solid basis in reality, but reality is distorted by a misconception. That's what makes financial bubbles so difficult to recognize. They usually begin with something real. The more transformative the innovation, the easier it becomes for expectations to outrun reality. If that pattern has repeated for centuries, what causes it to happen over and over again? To understand why these investment booms keep repeating, we need to go back more than 2 centuries. In 1776, the Scottish economist Adam Smith published The Wealth of Nations, one of the most influential books ever written. Smith argued that rising profits naturally attract competition. When one industry becomes unusually profitable, investors notice. New companies enter the market. Existing companies expand. More capital begins flowing toward the same opportunity. At first, that's exactly what an economy needs. More investment increases production, encourages innovation, and helps new technologies spread. But success creates its own momentum. As more businesses chase the same opportunity, competition intensifies. Capacity keeps growing. Eventually, supply begins to outpace demand. Profits start to shrink. What began as a highly profitable opportunity becomes an overcrowded market. More than 200 years later, investors gave this repeating pattern a name: the capital cycle. The capital cycle doesn't predict when a bubble will begin. It doesn't predict exactly when it will end either. What it does suggest is that periods of extraordinary profits often attract extraordinary amounts of investment. History offers countless examples. In the 1840s, railway companies raced to build tracks across Britain. Decades later, the automobile industry expanded at a similar pace. The late 1990s saw billions poured into fiber optic networks. Each generation believed demand would keep rising fast enough to justify almost unlimited investment. But supply often grew even faster. Many companies disappeared. Many investors lost fortunes. Yet the technologies themselves survived. In fact, they went on to reshape the world. That distinction may be the most important lesson as we look at AI today. One of the clearest examples unfolded in Britain during the 1840s. Railroads were transforming transportation. Money poured into railway companies at an astonishing pace. New lines were announced across the country. At the height of the Railway Mania, investors were convinced that almost every new railway would become profitable. But Britain didn't need every railway. When confidence finally faded, railway stocks collapsed. Many investors suffered enormous losses. Yet the railways themselves didn't disappear. They became the foundation of Britain's modern transportation network. The technology succeeded. The investment boom did not. And that difference has appeared again and again throughout financial history. Half a century later, investors found themselves caught in a remarkably similar story. This time, the excitement centered on the internet. As millions of people came online during the 1990s, demand for faster communication exploded. Telecommunications companies responded by investing billions in fiber optic cables. The logic seemed impossible to argue with. If internet traffic kept doubling, the world would need an enormous communications network, so companies rushed to build it. By the early 2000s, vast amounts of fiber had been laid beneath cities, across countries, and under oceans. But there was far more capacity than businesses and consumers could actually use. The oversupply drove prices sharply lower. Several telecom companies collapsed under the weight of their own investment. Yet once again, the technology itself wasn't the failure. Years later, that same fiber optic network became the backbone of cloud computing, video streaming, and the modern internet. The infrastructure proved valuable. It had simply been built long before demand was ready to support it. That's why history reminds us that being right about a technology doesn't always mean being right about the timing. So where does artificial intelligence fit into this pattern? Today's AI boom has many of the same characteristics that defined earlier investment cycles. Companies aren't simply building better software. They're racing to build the infrastructure that could power an entirely new technological era. Data centers are expanding around the world. Semiconductor manufacturers are increasing production. Technology giants are committing hundreds of billions of dollars to AI development and infrastructure. The expectation is clear. As artificial intelligence becomes more capable, demand for computing power will continue to rise. That may prove to be true, but history suggests the critical question isn't whether demand will grow. It's whether supply is growing even faster. Because if enough companies make the same bet at the same time, today's shortage can eventually become tomorrow's excess capacity. And that's where the capital cycle becomes especially relevant to artificial intelligence. If supply is the key, one company sits at the center of it, NVIDIA. Its graphics processors have become the foundation of modern AI, powering everything from large language models to advanced data centers. Demand has been so intense that major technology companies have spent billions securing access to its chips. But NVIDIA is only one part of a much larger system. Most of its advanced chips are manufactured by TSMC. Together, these companies have become critical suppliers. Meanwhile, Microsoft, Amazon, Alphabet, and Meta are investing unprecedented amounts into AI infrastructure. Each company has its own strategy, but collectively, they're making the same bet, that future demand for AI will justify today's enormous investment. History shows that this assumption can be right. The question is whether every company investing today can be right at the same time. Building AI infrastructure is one thing. Earning enough money from it is another. Today, the world's largest companies are spending at a historic pace. The expectation is that these investments will generate enormous returns, but history suggests there's often a gap between building capacity and earning profits. Infrastructure usually comes first. Revenue follows later, sometimes much later. The railways were built before they became consistently profitable. Fiber optic networks were installed years before internet traffic caught up. Artificial intelligence may follow a similar path. The technology could become essential, while today's investments take far longer to pay off than expected. That's why the biggest uncertainty isn't whether AI will matter. It's whether today's spending will produce the returns the market is already pricing in. So does that mean artificial intelligence is a bubble? History points in one direction. Not because artificial intelligence lacks real potential. Quite the opposite. The stronger the underlying technology, the easier it becomes for investors to believe that almost any price is justified. That's exactly what happened with railways. It happened again during the internet boom. And today we're watching unprecedented amounts of capital flow into artificial intelligence. The technology may live up to the expectations. It may even exceed them. But if history is any guide, the investment boom surrounding AI has all the characteristics of a financial bubble. Not because the technology is fake, because the money chasing it has reached extraordinary levels. That's a distinction investors have overlooked before, and history suggests they're overlooking it again. If history is right, the biggest winners of the AI revolution may not be today's investors. They may be the generations that benefit from the technology after today's investment boom has passed. That's happened before. Railways reshaped transportation long after the Railway Mania collapsed. Fiber optic networks became indispensable years after the dot-com bubble burst. The infrastructure survived. The speculation didn't. Artificial intelligence is likely to follow the same path. The technology will probably endure. But many companies investing today won't earn the returns investors currently expect. That's the difference between recognizing a revolutionary technology and recognizing a financial bubble. That doesn't mean investors should ignore artificial intelligence. It means that they should separate the technology from the investment. History shows those are rarely the same thing. The greatest innovations often attract the greatest excesses. Eventually, competition catches up. Supply overtakes demand. Returns fall. That's how the capital cycle has unfolded for centuries. And there's little reason to believe this time is fundamentally different. Artificial intelligence may transform the global economy, but the companies leading today's race are unlikely to all deliver extraordinary returns. History has seen this pattern before, and history rarely rewards those who ignore it. Artificial intelligence may become one of the most important technologies in human history. History gives us every reason to believe it will. But if the capital cycle has taught investors anything, it's that revolutionary technologies don't always produce revolutionary investment returns. When extraordinary amounts of capital chase the same opportunity, competition inevitably follows. Supply expands, returns decline. That's the pattern history has repeated for centuries. Artificial intelligence may change the world. But today's investment boom is following a path investors have seen many times before. The technology may be revolutionary. The bubble surrounding it is not. History changes its characters. Human nature never does. If you enjoyed this documentary and want to explore more of the financial events that shaped history, consider subscribing to Financial Cycles. Thank you for watching. I'll see you in the next documentary.